Happy Tuesday out there, Team 42. It's your skipper here, Darius Dell, to present our macro minute for Tuesday, September 9th, 2025. Hope everyone's having a great week. So as always, we'll start with our executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions and to see if you need to make any changes in your portfolio to remain on the right side of market risk or to get on the right side of market risk to the extent you haven't been following KISS or Dr. Mo, you need to be a client of 42 Macro. So today's key macro question is, what are small businesses and consumers currently saying about the U.S. economy? Our answer? A quiet day on the macro policy signaling front affords us the opportunity to unpack this morning's key high-frequency economic data out of the U.S. economy, specifically the August NFIB Small Business Optimism Survey and the August New York Fed Inflation Expectation Survey. Regarding the former, the NFIB survey data modestly supported our resilient U.S. economy theme and refuted our sticky inflation theme. Regarding the latter, the New York Fed survey data supported our sticky inflation theme, which has called for an equilibrium core PCE inflation rate of around 3% since January of 2022. We believe our data-driven research view continues to be supported by a broad swath of realized and survey-based inflation data. We believe the Fed is making a perpetual policy mistake by not revising its inflation target higher to 3% in this fork-turning-inspired fiscal dominance regime. A positive revision to the Fed's arbitrary 2% inflation target would allow the U.S. central bank to recalibrate its reaction function in a manner that treats the capital formation stroke we described in our September 2025 macro discussion report. Said simply, because Uncle Sam is gobbling up such a high share of the world's capital each time it taps capital markets for debt issuance, there is not enough capital left over for small businesses and low to medium income consumers to invest, purchase homes, or finance consumption. Pull up a chart of the small cap mega cap ratio for market-based confirmation of our view. In short, the data signal an economy that is muddling along somewhere modestly north of stall speed that is applying disinflationary pressure absent the one-time price level shift higher from tariffs. The U-shaped economy affords the Fed a window in which to correct the Powell Fed's fifth major policy mistake by resuming easing monetary policy and next week's FOMC. The key risk for asset markets over a short to medium term time horizon is a return of our Jay wants a strong legacy theme, which we scrapped after Powell's directionally dovish speech at Jackson Hole. Transition to our 42 macro dashboard. As always, I'll wrap up with a question from our community. This one's titled US dollar weakness and its implications. It says, hello, Darius. Thank you for your kind note yesterday. Very much appreciate it. And I very much appreciate you, my friend. Appreciate for all the support you've helped us, you provided to me and our business on this wonderful journey. Getting back into the question, it says your research and signals, both fundamental and quantitative, point to a weakening dollar. But to what extent? This is a very critical topic for all non-US dollar investors here, of which we have quite many. I want to say, I don't know the exact ratio, but the last time I checked was a while ago. I think roughly half of our clients are international. Of our thousands of clients, we have about 80 something countries represented across the world. So very international customer base, which we're super proud of and really grateful for. So obviously very important question for Team 42 here. So unpacking the question further says, while we can be confident with gold, Bitcoin, and high tech to stay on top, the more locally bound asset classes like U.S. REITs, bonds, credit, BDCs, midstream energy, utilities, and brick and mortar industrials can become uninvestable in front of a 20+% US dollar slide. Are we looking down the barrel of a gun here? Have a great week, my friend. So phenomenal question. So I'll be the first person to tell you, like, I have no clue, where the dollar is going to go from a valuation terms. You guys know I don't really believe in valuation metrics in terms of sort of positioning for and responding to financial market risk. I think there are much better ways. Wall Street has proven, as have we, there are much better ways to manage risk in global financial markets. However, we've obviously seen, I'm going to say we're dollars down about 12-ish% since it peaked back in late 2022. So from that point to, a further decline to about 90-ish on the DXY, which is our sort of a hypothetical exercise that we posited in Friday's macro scouting report. If we got down to that level, then you're talking about a 20+% peak to trough decline in the U.S. dollar index. So that would, obviously have a significant impact on the currency translated returns for U.S. assets. And so obviously that, behooves you as an investor to be in assets that are going to outrun that monetary debasement. Again, we've been saying since the summer of 2023, again, over 2 years now, that you should expect persistent financial repression and monetary debasement throughout the duration of this fourth turning regime. for a variety of reasons, both cyclical and structural, mostly structural in the context of that presentation. And this is why, part of the reason why we've constructed our KISS portfolio construction process, which is a life raft to thousands of investors around the world. The part of the reason why we constructed KISS the way we did in terms of the factor selection, stocks, gold, Bitcoin, is because we understand, I think at a level higher than most, quite frankly, that financial repression, monetary debasement, and an erosion of central bank independence, because are all things that you should expect and are consistent with what we've observed in the previous four turnings, in prior four turnings. And so at the end of the day, I think it's I think you have a choice as an investor. Do you want to be long, things like utilities and pie chart asset allocations where you're choking to death on bonds and assets and just financial assets that are unlikely to, outperform in a regime full of monetary debasement and financial repression? Or do you want to give yourself the best possible opportunity to retire on time and comfortably, emphasis on and comfortably, i.e. having a lot of money in retirement so that you don't go broke in retirement like a lot of people are starting to do, or have a comfortable journey along the road to retirement, which is counter to what a lot of people experience. That's why we designed everything we do here is obviously incredibly thoughtful. We're pumping out hundreds of slides of research on a weekly basis here at 42 Macro. Obviously, all our quantitative risk management signals that guide our KISS and Dr. Mo systems are, incredibly thoughtful in their own right. And so, when we construct an asset allocation which only features stocks, gold, Bitcoin, and cash whenever they're not maxed out, it's a signal in and of itself that, hey, this reasonably smart guy who's built 42 Macro is telling you that these are the assets that you need to be invested in to outrun financial repression and monetary debasement. If you don't want to outrun financial repression and monetary debasement, which is a code word for you don't want to have an on-time or comfortable retirement, that's fine. That's your choice. You have a choice. But we're not going to amend our financial life raft because you choose to, have a late and uncomfortable retirement, if at all. So just be aware of that. So getting back into this question, are these things going to become uninvestable? I have no idea. Let's be honest. The purpose I'm making is, if I'm talking to you as a retail investor, why are you making these choices? Why are you picking all these different factors? You don't need to be long REITs and midstream energy and brick and mortar industrial. These are all questions that you don't need to answer. Nobody is paying you as a retail investor to take factor risk in your portfolio. If there's one thing you learned from Darius Dale before I die, one thing, this is the most important thing I can teach you as a retail investor, is to completely stop taking factor risk. It's the hardest thing to do in institutional finance. And you guys are getting paid $0 to take factor risk in your portfolios. You can be long as much beta as you want. There's nobody going to come and fire you as an investment advisor because you're performing in line with the stock market, which they can achieve at a much lower fee. There's no one going to fire you because you're not long and short the right sectors and factors and stocks at the right time in the market cycle. No one's going to tap you on the shoulder and say, get out. You can just be long beta. You've the very, in my opinion, very enviable position of just being able to open up your basket, collect the manna from the heavens, called beta when it's there, and close your basket when it's not. That's such a wonderful competitive advantage as a retail investor. And every single one of you is squandering that wonderful competitive advantage away by choosing to take factor risk. I have no idea why you people take factor risk. It's nonsensical. If you learn one thing from me, it's to run the ball when you're on the 1 yard line at the end of the Super Bowl, when you have one of the greatest power running backs of all time standing behind the quarterback. So many of you are dropping back to pass and throwing an interception on the 1 yard line of the goal line of the Super Bowl because you're so convinced of your own intellect, of my intellect, of somebody else's intellect, that you should be taking factor risk. No, turn around, hand the ball to Marshawn Lynch and score the dang touchdown. It's that simple. Investing is that simple if you're a retail investor, but so many of you guys are complicating it. Stop complicating it. Just go make money. Go retire on time and comfortably. It does not require having to pick all these different factors. All you're doing is adding layers of stress and complexity and ultimately tracking error to your portfolio. And so that's why 42 Macro exists, is to teach people thousands of investors around the world that there is, in fact, a better way to retire on time and comfortably than the garbage that you guys have been consuming from Wall Street for many years. And you know why it's garbage? Because Wall Street sells the best risk management solutions to itself and keeps it for itself. And then they trickle down the whatever is left for you guys to get you to overtrade your accounts or take unnecessary factor risks or so on and so forth. And that's not what we're ever going to do here at 42 Macro. So sorry for going on a little rant there, but I'm obviously very passionate about this stuff and very fired up. And, to me, what's most important here is helping people retire on time and comfortably. That's why people like me exist. Unfortunately, there's not enough people like me. And so hopefully by the time I retire, that there'll be a whole legion of investors with services like mine that are focused on delivering these types of outcomes to their client base. And so if something must have went horribly wrong in my life if that's not true in 20, 30, 40 years. So we'll appreciate you guys. Thank you so much. I appreciate the compliment and the question. We'll catch you guys back here tomorrow. Everyone have a wonderful day. Cheers.